Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, January 25th, 2022. Glad to have you back on the podcast, George, and glad to have you back in the hot seat. It's been a while.
Yeah, it's great to be back to share views with you, John. Missed the interaction.
Yeah, for sure. And I totally enjoyed the last three podcasts where you interviewed contributors to the 2022 outlook. Really good stuff. Hopefully we get a chance to do something similar again. But let's dive right into it. So George, one of the key themes you laid out in that 2022 macro to markets outlook was the feedback loop between Fed tightening and financial conditions. And much like really everything this year, that has played out in spades and so quickly. Look at losses across stock markets, elevated measures of both realized and implied volatility in the stock market and other markets, the sell-off in rates, wider spreads, et cetera, et cetera. I could go on for a while. But I guess my question is this it? And if this is it, is it over? Is it just beginning? Take us through that a little bit.
Yeah, no, absolutely. So it's been a fast and furious move in rates, and then that led to the sort of moves that we're seeing in other markets. And ultimately, which is something that we said in the 2022 outlook, which was if it gets volatile enough and there's actual losses in other markets, that eventually that would result either into flight to quality flows back into treasuries and fixed income, or at least it would slow down the sell-off in rates. And by and large, so far that's happened. And so, the 10-year got up to 190. We've been kind of trading back sub 180 in the 170, 180 range. The vol, although has been elevated, it's been also sporadic at times. But like the ongoing losses really in the stock market, I think it's what's really catching everyone's attention. But yet, if you kind of look at like the broader financial condition indices, they're still not at levels that are, that are really worrisome yet, and that kind of does, call into question: will the Fed take notice enough? And I think that's something that people are trying to figure out. Is the Fed worried about the recent market gyrations? And based on most kind of big macro financial condition indices, it's not big enough yet for it to really matter, at least as a feedback into the economy. But there's definitely this kind of interplay between Fed expectations and financial conditions, because let's be honest, the Fed hasn't even hiked yet. So we're all kind of projecting forward, and we've had a big embedding in the curve of 3 to 4 hikes. Now we're at somewhere in between, around close to 4. And so all of this is just the expectations channel working in overdrive, and it's leading to a pretty big de-risking in the sectors of the markets that have benefited from excess liquidity over the last 18 months. That's primarily high beta tech. Even crypto has been having a difficult time. So I think this is, par for the course for a market that's getting ready for a faster Fed cycle. But I'm not sure this is it, or what does this is it mean anyway? I don't think this is like the end or the beginning. I think this is just like a precursor for what might look like a bigger financial conditions tightening later in the year. And that, to me, is really what is a big focus of ours. Is can the markets withstand a much more active and hawkish Fed, and at what point is there the feedback loop is so big and that ends up kind of derailing something in markets or breaking something, as they say. And that, I think, is still lies ahead. I don't think this is the big one. I think this is really just an example of what could happen if there's more tightening to come.
Well, that is a terrifying appetizer. So you just recently published your monthly macro to markets report, and you this financial condition stuff is something that you discuss and update. Give us a quick recap on that and the report more generally.
Sure. One of the big pieces that we cover in the report is the role that real rates play in this whole idea of financial conditions tightening. And when you've had a number of times now in the last decade when real rates get super negative, and this time there were we reached the lowest negative rates in real rate space on record in the U.S. at least. When you have those sort of episodes, it does encourage risk taking into other asset classes when there's the typical reach for yield, or you need some spread pickup. And so like this real rate driver was a big part of what led to tighter credit spreads, and just overall risk appetite increased in the last 18 months. We've had a pretty big reversal in real rates, and that to me is what we have to be looking for going forward. Whenever we have these sharp repricings in real rates, they usually consolidate, but the problem is we're coming from such low and negative rates that even for example, the 5-year TIPS real rate moving up roughly 80 basis points from the local low has only brought us back to like 120 negative basis points. So we're still 1.2 negative on percent terms in real rate space. And you could see a situation where we can get back to at least zero, and another 100 basis points of tightening of real rates would really start to hurt markets. And so I think it's trying to understand how high can real rates really go? Will the Fed tolerate it? Typically, when the Fed is hiking rates, real rates rise. But also, what we saw during the 2017, 2018, early into 19 period, when the Fed was shrinking its balance sheet, which QT is all the rage, but the Fed has done QT before. This is actually like now, if they go ahead with quantitative tightening, it would be QT2, I guess. And during that first QT1 period, which was only implemented after they really started hiking, but nonetheless, when they started the QT, there was a pretty big rise in real rates. And so with the Fed discussing both a faster hiking cycle and shrinking the balance sheet, it's no wonder that real rates have reacted quickly, and there's potential scope for more. And that's why, the answer to question one, when we're discussing, is this it? I mean, I think the key to it will really come down to like how much can real rates move, and how does that kind of feed back into the financial conditions and then into other overall markets that are very interest rate sensitive.
Thanks. That's super helpful. I mean, I think between the sort of the roadmap you've laid out, in terms of looking at tightening financial conditions, as well as watching real rates, that sounds like a pretty good roadmap to follow. It's been a good roadmap for the first 3 weeks of the year. I suspect it's going to be a good one for the remainder. But moving on, you've mentioned the Fed a couple of times here. As a reminder for our listeners, we are recording this podcast on Tuesday, January 25th. That's just one day before the Fed concludes its January policy meeting. So, George, to wrap things up, what should our listeners be watching out for at tomorrow, or depending on when you're listening to this, today's FOMC announcement?
Yeah, no. So with all this stuff that we're all these linkages around financial conditions and Fed and just views around the Fed, like tomorrow or the Fed meeting, this January upcoming meeting, is super critical for what might happen next. I mean, there's the prevailing argument and view out there is that the Fed should just look the other way and just accept that there's going to be volatility and markets will have to adjust, and there's going to be rotations as they start to take away this easy money from either the balance sheet or hiking rates. But I mean, I think that's on the surface that sounds very clinical and very doable, but at the same time, we live in the real world where there are these kind of feedback loops, and I think that we can't ignore them. And so, and I don't think the Fed does either. I think actually financial conditions plays a very big role in their thinking, considering how financialized the U.S. economy has become in the last 20, 30 years. So I think that given that it's a January non-quarterly press meeting, we will not get updates to their forecasts. I mean, obviously, Chair Powell can mention their latest thinking in the press conference, and I'm sure the statement will have an update in the interim meeting period. I mean, there's been some deceleration in the economy, but nothing really that's that noteworthy. I mean, there's obviously been Omicron, and there's the issues around that and what it means for the economy. But I think the Fed's going to take this opportunity to be forward-looking and really try to ensure that they can have the ability to hike in March. So in my view, in order to do that, I think that they should be pleased that the markets have adjusted. There's been enough hikes, again, priced into the curve. If you're Chair Powell and the various Fed members, you would take this opportunity as just kind of baselining things and just saying the market's kind of come to the right place, but I don't think you up the ante and become even more hawkish. I think this is not the time to do that. I think you kind of try to send a balanced, neutral message that they're obviously watching markets, but they're not necessarily overly concerned. But at the same time, they're just watching how things are evolving, and also try to deliver a more positive upbeat on what Q2 and Q3 should look like on the economy. I think that's, if they can do that, and as well as give us that they're on track for finishing tapering. I don't think it will be appropriate to also fast track tapering. We'll see. I don't think they're going to do that. I think they take the opportunity just to finish what they started and then set up for the March hike, which is really the important piece of the puzzle to get liftoff done properly without markets in this sort of kind of gyration that we've been in. So I think that's what we expect. We'll see. We'll learn more tomorrow. It's going to be an interesting press conference, to say the least. I mean, the Q&A is where we're going to really learn a lot. But Chair Powell, if he has a message to deliver in his opening statements, they can take that opportunity to say, we further discuss the balance sheet or whatever they're working on. They're clearly doing a deep dive into the right policy mix, as we learned from the December minutes, which came out in early January, which really kind of kicked off all of this kind of speculation about what the Fed's going to do next. So I think that they're going to be neutral, kind of clear up some of these lingering concerns, and focus on March.
Okay, thanks. So we'll look for the Fed to kind of bless kind of current market pricing, but not necessarily advance it as they worry or as they want to be mindful of financial conditions. So for more, I would definitely encourage our listeners to check out the January edition of the Macro to Markets Monthly. That includes an in-depth discussion of this real rate story George just outlined. And again, if you are not receiving George's strategy reports directly, please reach out to your MUFG sales coverage or get in contact with George. And thanks again, George. Great stuff as always.
My pleasure, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts, and reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.